Hi, welcome to Her Finance, a channel dedicated to empower girls and women in their financial journey. Have you ever looked at all the different investment options out there and just felt completely overwhelmed? Then this is for you. I'm going to lay out a really clear map starting with the super safe stuff and working our way up so you can figure out exactly where you want to begin. So, let's just start with a really important question. I mean, you work hard for your money, right? But is your money working hard for you? Or is it just kind of sitting there in a bank account, slowly getting eaten away by inflation? Yeah, let's change that. So, what are we going to do is explore a really clear path for your money. Think of it like climbing a ladder. We will start on the very first rung, the most secure foundation, and then we'll move up step by step options that have a lot more potential for growth. Are you ready? Let's get started. So, our first step, this is the ground floor. We are talking about the foundation of all personal finances, the bank. This is your ultimate safety net. So, what is a bank really? Just think of it like a super secure vault for your cash. It's safe, it's insured, and they even give you a little bit of interest for the privilege of holding it. But, and this is a big but, that safety definitely comes with a price tag. And here is the fundamental trade off you got to understand. On one hand, you've got your standard savings account. You can pull your cash out anytime you want, which is great. But the interest you earn is, well, it's pretty low. But if you're willing to lock that money away for a little while in what's called a fixed deposit or an FD, the bank will reward you with a much, much better interest rate, something maybe 6 to 8 percentage. Let's use this figure as our baseline. Keep that number in your head because now we are going to see how we can do even better. Now it's time to climb up to the next rung on our ladder. We are moving on to bonds. Now, this is a pretty cool shift because you're no longer just a saver, you are actually becoming a lender. So, what exactly is a bond? The easiest way to think about it is like a formal agreement. You are literally lending your money to a big entity like the government or a major company. In return, they promise to pay you back in full plus regular interest payments along the way. It's a structured deal that usually pays out better than just leaving your money in the bank. And what's cool is that you've got options here. If you want maximum safety, you can lend to the government by buying government bonds. They are considered about as low risk as it gets. Or you can lend to big companies with corporate bonds and you will probably get a slightly higher return for that. There are even special ones like sovereign gold bonds, which are tied to the price of the gold. So now we are talking about returns in the neighborhood of 7 to 10 percentage. So it's definite step up from the bank. You are taking on a tiny bit more risk, but you're being rewarded for it with a better potential return. Now we are about to make a pretty big jump up the ladder. Next, we are talking about stocks. And this is a fundamental change in mindset. You're not a saver, you're not a lender anymore. You are an owner. See, when you buy a stock, it's not just some random ticker symbol on a screen. You're literally buying a tiny, tiny piece of a real company. Think Tata or TCS or whatever. And that means if the company does well and makes a ton of profit, the value of your little slice goes up. Of course, the flip side is true too. If they struggle, you are along for that ride as well. And that brings us to the $1 million question, right? Why do stock prices jump around so much? It can feel totally random and chaotic, but I promise you there are real reasons behind it. A stock's price is really a mix of few key things. You've got the hard facts like how well the company is actually doing, and then you've got your own feelings, what we call as market sentiment, which is basically the collective mood of all the investors out there. Let's look at a few examples. Okay, let's start with the most obvious one, company for performance. It's super straightforward. When a company like Tata releases a new car that everyone loves, their sales go through the roof, their profits soar, and naturally, investors all want in. That demand pushes the stock price up. Simple as that. But here's where the get wild. It's not just about the numbers, it's about human emotions. Just a rumor of a recession can be enough to make people panic and start selling of their stocks. And when everyone sells out of fear, prices go down, even if the company's business hasn't changed at all. It's kind of like a self fulfilling prophecy. And then, of course, you've got the big unpredictable world events that can just shake everything up. I mean, we all lived through it. When the COVID 19 pandemic hit, the sheer uncertainty sent a massive shock wave through the global markets, causing a huge sell off pretty much everywhere. So let's recap. Stocks have amazing potential for growth, but they're also volatile and, let's be honest, kind of complicated. So, what if you could get all the upside of being an owner without having to spend all your time trying to become an expert stock picker? Well, that's exactly what mutual funds were invented for. The best way to picture a mutual fund is to think of it like an investment basket. Someone else, a professional manager, does all the hard work. They go out and pick dozens, sometimes hundreds of different stocks or bonds, and they put them all together into this one basket. And you just buy a share of the whole basket. And the really great thing is, you can pick a basket that matches your own personal comfort level with risk. If you are chasing higher growth, you can go for an equity fund, which is mostly stocks. If you prefer safety, you can pick a debt fund, which is mostly bonds. Or if you want something right in the middle, a hybrid fund gives you a nice balanced mix of both. And all of this leads to the single biggest benefit of mutual funds. It's a fancy word, but a simple idea, diversification. You know the old saying, don't put all your eggs in one basket. That's it. Instead of better everything on one company, your money is spread out across many, which really helps to cushion the blows when some of them inevitably have a bad day. All right, we have come a long way, right? We started at the very bottom of the ladder with the safety of a bank account and climbed all the way up to the world of mutual funds. So now let's just take a step back and look at the whole picture. This chart really sums it all up over on the far left. You have got the bank's super low risk, but that also means lower potential rewards. As you move to the right, first through bonds and then into stocks and mutual funds, the potential for growth gets much, much bigger. But, and you know this was coming, so does the risk. The whole idea is to figure out where on this line you feel comfortable getting started. So there you have it. That's a basic map of the investment world from the safe, calm shores of the bank all the way to the exciting mountain peaks of the stock market. We have given you the map. Now, the only question left is, where are you going to begin your journey? Do subscribe, share to keep enhance our financial learnings.